Hey guys, hope you had a great weekend. Mike's out of the office today, so I'm doing the call. Everyone else is here, and Mike will be back taking calls tomorrow. So if you have any questions, you can always call in here, or you can call into ECA. And like I said, Mike will be back in the office tomorrow. So a couple things as we get started. The first being that this call will probably go short. So I'm expecting we would be done about 20 till, quarter till, so it may not take as long today. The other thing is, if you've seen me do these calls before, you know I don't watch that question box as closely as maybe Mike does. So if you ask a question and I don't answer it, I'm not ignoring you. It's probably that I don't see it. Today's call is a little bit complicated in the beginning. I think the second part of the call is easy to understand. The first part of the call is a little bit counterintuitive, so if you get lost or you don't understand something, if I don't see your question, you can call me and I'd be happy to run through it with you or talk to you about it later today. So the first, I would say 25 minutes or so, we're going to kind of geek out on investment theory and then kind of ask ourselves this question: how is this going to affect me and my clients going forward? Because there are some changes that are happening, big changes that I'm sure you all have noticed. That'll be about the first 25 minutes of the call. The last 15 minutes or so, we're going to kind of look at something wedged in the tax bill that Congress is working on right now. And then we're going to ask ourselves, how can we use that when talking to the people that we meet with? All right, so first things first, the 5Q 5-minute moneymaker. You got this on Wednesday, I believe, and so if you look at it, it says that a Paladin survey of 386 investors found that 75% of them use the internet to research their advisors anonymously. And what's even scarier is that over half of them judged the advisor's trustworthiness right then and there on the computer screen, sight unseen. So a couple of takeaways from that. First of all, you know, we have to realize and understand that people are looking at us, whether we know it or not. They're looking at us. And so you really need to look at your website and ask yourself, is it about the value that I bring to the table, or is it more about the products that I sell? So make sure you're projecting your value and not the products. Now I see a couple things when I look at other guys' websites. It isn't so much about the product as it is about the process. They're talking about, hey, you know, when you come in and meet with me, I'm going to do a thorough fact find, and then we're going to kind of do this evaluation, and then you're always going to be in control, and only until the evaluation is done will we then discuss, you know, solutions, and then the follow-up to that will be step 4, the implementation. That's okay. I mean, that's better than product, but to be honest with you, that's a half step up from product. That's still not talking about the value that you see or that you bring to the table. So really make sure that when you take a hard look at your website and you look at your office and you look at your procedure when people make appointments and come in, that you're really in those first few minutes projecting the value that you bring, and not so much just projecting yourself as somebody with a sales process that we're not going to sell you anything that doesn't fit you. That's kind of what you're saying. You know, there's a saying that says, first impressions are lasting. And the reason that we all know that saying is because it's really true. You only get one chance to make a first impression, so really think about what kind of a first impression that you're making. But there is some other news wedged into this, and it's down there in the middle. Here's the good news. These people have a strong preference for small firms. They don't really want to work with the big firms. So people want to work with you. And so make sure you're out there so they can find you. If you're not out there marketing yourself, even though they're looking for you, they're not going to find you. So let's make sure you're out there. You also got the 5Q breakdown. Okay, and this week's was a 1-minute snippet of the beneficiary script. But as a reminder, these are kind of weekly tape reviews. So spend some time with them and really learn from them. Don't just listen to it once and then delete it. Really learn from it, because I get this all the time. Geez, I wish there were tapes of other people that we could hear listening and see what they do, the mistakes that they make, or them doing it right. And that's what this is, along with the tape reviews that we do periodically every month. That's exactly what this is. Now, we always say, you know, the most valuable 15 minutes of the day is the time you spend doing your 15-minute drills. And so the best tapes for those drills is tapes of you meeting with your clients and your meetings. So if you've got those are the tapes to use for your 15-minute drill. But if you're new and maybe you don't have tapes of you actually meeting with clients, these are great tapes. These can work for that. And so at the very least, spend some time with them and use them for your 15-minute drills if you don't have tapes of your own. All right, so we're going to go ahead and get started with kind of the meat of today's call. And to start, I want to show you this picture. This was painted by a guy by the name of John Trumbull. He's a famous American painter, and this painting is called The Surrender of Lord Cornwallis. Okay, so what it depicts is the British forces surrendering to the American forces at Yorktown, Virginia, and for all practical purposes, that ended the Revolutionary War. Now, tradition has it that when the British surrendered, their band played the old English folk tune called "The World Turned Upside Down," because for them, this was really an upside down moment. You have to remember that back then in the 1700s, it was Britain and France and Spain, and those were the superpowers. And a superpower had been defeated by American forces that didn't even exist several years before. So everything was flipped on its head. And we know in hindsight that things were going to change a lot more than they did that day, that Britain would start to decline and America would become one of the 2 or 3 superpowers in the world. So it was the beginning of a really big shift. And I'm kind of reminded of that because since 2008, when the market crashed, from then until now, we've seen a massive movement of money and a shift in investment thinking. And it's really been tectonic. And it's kind of moving the ground beneath our feet in this industry. And you've all seen it. You've all experienced it. This isn't going to come as a surprise to you. You're seeing it all the time. You're hearing about it. You're working with it every day. That tectonic shift in investment thinking is that money is pouring out of active management and into passive investing, things like index funds and ETFs. So you guys are going to see a lot more people that have a lot of money with Fidelity and a lot of money with Vanguard. And when I say that they're shifting from active management, I don't mean that they're necessarily working with money managers. I mean that they've got an actively managed large cap mutual fund. And you're going to start to see more and more portfolios where what they have are ETFs, or they have 500 funds, S&P 500 funds. You've all seen it. When you guys send in the statements for the Morningstars, I see it too. So this isn't new to us, this idea that money is pouring out of active management and into passive management, which would be things like index funds and ETFs. In fact, Barron's Magazine, they've done a number of articles about this. But here's one quote from one article where they say, "We still call it a stock market, but these days it has many more indexes than it does stocks. There are nearly 6,000 indexes today, up from fewer than 1,000 a decade ago. Meanwhile, the number of stocks in the Wilshire 5000 Total Stock Market Index has shriveled from 3,599 from 7,562 in 1998. So think about that. There were only about 1,000 ETFs and indexes even 10 years ago, and now there are about 6,000. And 20 years ago, there were 7,500 stock companies, and now there are 3,600, let's call it. So there are way more indexes than even stocks. That's a big indicator of what's going on. And they go on further to say this: there's no question who's winning the popular vote. Investors have been pulling money from active funds and plowing it into their passive peers. Through the first 5 months of this year, investors steered $338 billion into passive mutual funds and ETFs. That's on top of last year's record inflows of $506 billion, according to Morningstar. If this pace keeps up, passive funds could take in more than $800 billion in 2017, a 60% jump from 2016's record and nearly double the haul from 2015. So this is something that's happening on a huge scale. Hundreds of billions of dollars each year are moving into passive funds. In fact, it's well over $1 trillion. It's practically $1.5 trillion over the last 2 or 3 years. That's a lot of money that's moving. And there are a few reasons that this is happening. The first is the VIX is low. And no, I don't mean this VIX, I mean this VIX. The Chicago Board of Exchanges Volatility Index for the S&P 500. It's got the ticker symbol VIX, which is why it's commonly referred to as the VIX. It's a measure of market volatility, and volatility is really, really low right now. Now, if you're not familiar with the VIX, the first thing to understand about it is it's literally a derivative of a derivative. So it's a completely artificial construct. It's kind of ephemeral the way that they measure it. So if you're not familiar with it, this is what Investopedia says about the VIX. The VIX is the ticker symbol for the Chicago Board of Options Exchange Volatility Index, which shows the market's expectation of 30-day volatility. It is constructed using the implied volatilities of a wide range of S&P 500 index options. This volatility is meant to be forward-looking, so it's kind of a peek into the future. It's calculated from both calls and puts and is widely used as a measure of market risk, often referred to as the investor fear gauge. So what they're measuring is, what they're trying to measure through puts and calls on the indexes is what are investors thinking? Are they optimistic about the market? Are they pessimistic about the market? Low volatility means we're optimistic. High volatility means there's more uncertainty and we're more afraid. And I wouldn't draw too much from this. Just as a point of reference, 20 seems to be the magic number for the VIX. A VIX above 20 is considered high market volatility. A VIX below 20 is considered low market volatility. Now here's an interesting fact. Here's something to really kind of chew on for a few minutes. Since 1990, so in the last, what would that be, 27 years, there have been 39 times when the VIX is closed below 10. So that's extremely low. Anything below 20 is low. Anything below 10 is extremely low. Of those 39 times in the last 27 years, 30 of them have happened this year. And we're not even done with the year. I mean, think about that. 30 out of the 39 times it's closed below 10 have happened in 2017. Now again, you can't draw any conclusions about the next move of the markets from that, because the VIX could spike to 50 tomorrow, or it could stay low like this for a really long time. But you can see from this chart, this is going back to November of 2016, that the VIX is really trending lower. It's been low and it's trending lower. So volatility is really low. Just as an aside, I always think this is kind of an interesting graph. So in the red, it's talking about economic policy uncertainty. So there's a lot of uncertainty about what the future is going to bring when it comes to economic policy. And you might remember that Mike a couple weeks ago was talking about this. Do we have more or less certainty about what's going to happen in the Middle East with countries like Iran? More uncertainty. Is there more or less uncertainty when it comes to dealing with countries like North Korea? Well, there's more uncertainty. Well, what about the debt? What about the Fed? What about interest rates? I mean, we don't know what's going to happen in the future, and we're very honest about that. I mean, if you poll people, they'll say, you know, I'm not sure what the future is going to bring. I mean, I'm a little bit worried. It could go either way. But if you look at the equity market uncertainty as measured by the volatility index, the VIX, it says economic policy uncertainty, the future, what we think about what can happen in the future, is higher than it's ever been. And yet we're more certain that the markets are going to go up than we've ever been. So there's a little bit of a disconnect there. And I'm not going to draw any conclusions from that other than just to say, I just think that's interesting. But you can see that low volatility and relative certainty about the general direction of the market means there isn't much need for active management. I mean, we don't need a lot of investment advice if all the markets are going to do is go straight up. And so people are saying, heck, I can just put my money in a Fidelity fund and do just as well as the active manager. And you're going to see that that turns out to be more than true. Not only are they going to do as well, they're probably going to be doing better. But this low volatility is one reason that we've seen this massive shift away from active management and into passive investing. People are just thinking, heck, I could do this myself. I can make money in this kind of a market without anybody's help. The other reason, that's one reason. There's another reason that we've seen this big shift, and that is costs are lower when it comes to passive investing than active management. And we all know that. I mean, you can look at the cost of an index fund or an ETF and know that it's a lot lower than anything that we could charge or any of the managers that we recommend, or even the active managers inside of an active mutual fund. We talk in one of our scripts that the active managers generally charge in the 1% range. That if you're paying 1% for management, that's about right. That's good. But if you look at these ETFs and these index funds, they're charging 15 or 20 basis points. I don't think I need to explain a lot of this. We all know that passive investing is a lot cheaper. But that's another reason why we've seen this shift in hundreds of billions of dollars going from active management to passive investing. Everybody thinks that because volatility is low, we don't need advice. And heck, the costs are lower, so we ought to just shift and move over. So that's another reason. There's one last reason that there's been this big shift from active management to passive management, and that's the thing that I really want to zero in and talk about today, and that is that active managers are giving up because they haven't been able to compete. Now, it's extremely difficult in a low volatility and kind of a low cost environment for an active manager to buy the best companies or short the worst companies and show much outperformance relative to passive index funds. It's just tough. I mean, when they can charge so much less and they're doing just as well, it's really hard for an active manager to beat the index. And because they haven't been able to do it, a lot of them are just throwing in the towel and saying, you know what, I'm not doing this anymore. I'm just going to disband the fund. See, here's the real problem, and this is where it gets a teeny bit complicated. No matter how much research the active managers do, and no matter how well they know the companies, their research isn't going to give them an edge because of the massive amounts of money that are moving from active to passive management. And that point probably needs a little bit of explaining. Okay, so think of it this way. When you move to passive investing, when you move to an index fund or an ETF, what you're really doing is just allocating your money across a number of indexes that buy indiscriminately. Okay, what I mean by that is when I buy the S&P 500, I'm buying all of the companies inside of the S&P 500. So imagine, for example, that you're going to buy an index fund. You're going to buy the Russell 2000. That's small caps. Now, I'm going to use them as an example because I think it's easier to see what's going on when we talk about small caps. When you buy an index small cap fund, you're not only getting the stocks of well-run companies, but 30% of all small caps have less than zero earnings. So there's some dogs in there. You're getting a lot of good companies, but you're getting a lot of bad companies as well. And because we're moving hundreds of billions of dollars from active management to passive investing, those dogs are also seeing a flood of money being poured into their stocks. So we saw the numbers in Barron's earlier. It's over $1 trillion over the last 2 years, and we're not even done with this year. And when even companies with less than zero earnings, with negative earnings, are attracting big money, it's driving up the price of their stocks. An active manager can't even look at the fundamentals of a bad company and say their stock is going to go down. It's not. It's going to go up because a lot of money is pouring into them just as much as it's pouring into the other companies because they're part of an index. There isn't any way for active managers to find an edge. There's no alpha. And so they're getting out of the business. They're bowing out and just abandoning their active funds, saying, I can't do it. I can't find alpha. I can't attract investors. I'm out. And so that's the third reason that you're seeing a lot of money moving from active managers to passive investing. Now, those things that we talked about, that low volatility, those low costs, the fact that active managers can't find alpha, I mean, those things are really good reasons for the shift, and we should expect and maybe even cheer for these things to continue. But it means a couple of things for us as advisors when we sit down and talk to the people who come to see us. It probably means, number one, that you're going to have to change how you present your growth options, especially if you're advocating for active managers. Now, I'm not saying you shouldn't recommend active management. And I'm not even saying you should recommend passive things. I'm just saying you need to be aware that when you recommend active management, that you're swimming upstream. That there are a lot of people, whether they're doing it there in front of you or doing it when they get home, they're rolling their eyes at your pitch and saying, I can do better than that. I can do just as good as him. I've done just as good as him. I've done, and that's probably true. You're swimming upstream. So you're going to have to rethink how you position your growth options and really, quite frankly, what you're recommending. But more than that, well, we can't beat the 15, 20 basis points that they're charging for an index fund. You're going to have to rethink the way you position yourself and the value that you bring to the table. You can't beat them price-wise. You're not going to be able to join them. And we've been preaching for a while the 21-point checklist as an antidote to all of that because it makes the value that you bring tangible and real. They can see these things. They can feel these things. They know that these other things like the electronically filing the medical power of attorney, the quality of life directive, the property casualty checklist, they help with the titling and the beneficiaries. Those are all real. And they can all make a difference in somebody's long-term financial well-being. So it gives us the tangibles that we, quite frankly, have to be able to justify our fees. So going forward, this 21-point checklist is going to be extremely important. I think maybe you're starting to see it already. You can probably get by with not doing it or maybe only doing it halfway. But that's going to be less and less true as we move forward. It's going to be less true in 2018 than it was for 2017. And even less true in 2019. So you're going to have this. The other thing that you're going to have to do, though, is you're going to have to really shore up and really take seriously your safe money options. And here's why. This is kind of the symbol of a bull market. But this could quickly become this, which is a stampede to the bottom. And a lot of economists are starting to wonder if this shift from active investing to passive investing is going to make the downturn more sudden and severe and make it harder to recover from. So let's talk about that for a minute. It's kind of counterintuitive that, hey, the more money that goes into passive investing, the more likely we are to see a more sudden downturn and a more severe downturn and not recover quite as quickly. So let's see if you try and follow along here. I know it might seem a little bit counterintuitive, but index investing means that traditionally it's kind of a domino effect. What happens with index investing is that our decisions are on autopilot. We pretty much just say if we're going to diversify, we'll buy a large cap index, a mid cap index, a small cap index, and an international index. We set it and we forget it. And then that's the great thing about passive investing. That's one of the things that attracts people to it. Your investment decisions are on autopilot. But remember, we said there's a lot of indiscriminate buying. When you're buying an index, you're buying all the companies in that index. You're buying good companies and bad companies. And so money just goes into companies that comprise the index without any regard for things that have traditionally guided investors. Things like, how is the management team doing? What's the growth potential of the company? If you're looking at Apple, what do we think is going to be the demand for the new iPhone? None of that is going into any decisions about which companies to buy anymore. If you're part of the index, money's going into your company. And so what we've seen, especially with these indexes, and this would be the vast majority of them, they're weighted towards the big companies. What happens is that money goes into the biggest companies, whether they're actually performing strongly or not. I'll give you an example of that. A good example of that is if you looked at a large cap fund, every single one of them is going to have Tesla. Tesla is going to be a big part of a large cap fund. But I'm not sure. I don't own Tesla and I don't really follow Tesla, but it wouldn't surprise me to find that Tesla doesn't have very much earnings or maybe no earnings at all. I mean, this is a company that's still putting out electric cars, which there isn't a whole lot of demand for that. I mean, it's growing. And I'm not saying you shouldn't have Tesla or it's a bad idea to have Tesla. I'm just saying it's a big part of the index and it might not have the performance to justify that. The result is you have stocks inside these indexes that easily and regularly trade at 15 or 20 or more times earnings. And to compound that, when you think about it, every new index dollar goes into the exact same place as previous dollars did. The indexes rarely change. So the dollar that you put into indexes a year ago went into a pool of companies, and the dollar that you put into an index this year is going into the same companies. These same companies are attracting all of the dollars, which guarantees that the biggest companies stay the biggest and they get even bigger. And their stock prices just keep going up. There are no valuation or other parameters that go into that decision. They're just part of the index. The dollars go into it, whether they're well run or not, whether they have earnings or not, whether they show a profit or not. And so what you have with indexing is a perpetual bubble making machine. Now, don't get me wrong, there would be bubbles even if money wasn't moving from active to passive investing. We've always had bubbles for as long as there's been a stock market. But here's what normally happens when there's a bubble. It pops and there's a correction. And so the price of that stock or stocks falls until active managers say, hey, let's jump in. This is a good price for that company. I mean, it was overvalued before, but now that it's fallen, I think that's a good price. Let's buy. And that's what puts the brakes on the fall. Active managers saying, hey, I think there's value here. I think we could buy this and make some money here in the next month or two. That's what breaks the fall. But here's the problem, and here's where it gets tough for the majority of our clients who have a lot of money in indexes. When, not if, when the bubble pops, because it always pops. Remember, these indexes are churning out these bubbles. When they pop, because of the enormous scale of the shift from active to passive investing, you start to have to ask yourself, as the active managers get out, who's left to buy these ETFs when they start to fall? Who's left to buy ETFs after all the active managers have headed for the exits? Because they're the ones that usually put the brakes on the fall. And there are fewer and fewer of them. And I'm not saying there won't be anyone that'll put the brake on the fall. There will be someone. But because there are fewer and fewer someones every year, what starts out as a small correction could inadvertently become a big correction because of these trends. So what would normally be a 7, 8, 9, 10% correction, because of the dearth of active managers that are left, could become a 20, 25% correction. There's just no one to put on the brakes as quickly. And that puts a lot of our clients on the front lines of a big hurt. Now, the only thing that's going to protect your clients from that stampede to the bottom is the money you have investments not in the stock market. So it's going to be increasingly important that you have, we can't rely on the active managers to be that brake anymore. They're not going to be around to be the kind of brake that they were before. They're not going to be there to put out the fires anymore. The only thing that's going to be there to put out the fire is the thing that you have that's not in the market, that isn't subject to loss. So make sure you have that thing in their portfolio. Make sure that that 25, 30% correction isn't all their money. That you have money outside of the market so that they're not taking the full brunt of that. I like this quote by Warren Buffett. He says, "A bull market is like sex. It feels best just before it ends." And sadly, I think a lot of people are feeling really good right now. This probably dates me, but if any of you ever saw that show Hill Street Blues, the sergeant would brief all of the officers, and then the last thing he would tell them is, be careful out there. And that's what I would tell you guys, be careful out there. It isn't that we couldn't see more gains and that we shouldn't feel good. It's just that you've got to be careful. We're in an environment and we're seeing trends that are going to make corrections more sudden, more severe, less likely to be an early break. All right. Another reference that probably dates me, Monty Python. Now for something completely different. Congress right now is looking at a tax bill. And I think the odds that it's going to go through are probably a little bit better than 50-50. So we got to really take a hard look at this tax bill. This new tax bill has a provision in it that doesn't look like a big deal, but it can really affect us and our clients in a big way. So right now, things like Social Security's cost of living adjustments are tied to something called the CPIW, which is the Consumer Price Index for wage earners and clerical workers. What they're talking about in the new tax bill is changing that to the CPI, the chained CPI. And so I think this explains the chained CPI better than anything that I've seen in a while. It's the chicken talking to the pig and the cow saying, will you two stop saying everything tastes like chicken? What the chained CPI is this, it's kind of this idea that when the price of things, for example, let's say there's a family that eats a lot of beef, pork, and chicken. You know, they probably eat equal amounts of all three. But if beef and pork start to become expensive, they just start eating more chicken because it's cheaper. And so that's that substitution, that idea that consumers will gravitate or move to that thing that's cheaper, kind of causes that cost of living adjustment. That assumption means that we don't have to raise the cost of living for inflation as quickly or by as much, because it doesn't happen as fast. What happens first is people switch to a cheaper thing. If butter is expensive, they just switch to margarine. So we don't need to raise the cost of living adjustment because people are in the process of switching to cheaper things. They're really not spending more. We know that's probably not as true as most people would like to believe. This is something that AARP is very much against. They've tried this a few times in the past in different budgets to get it changed from cost of living adjustments for these kinds of things to be changed from the CPIW to the chain CPI. They haven't gone through, but I have a feeling this time it may. You don't hear about this much. It doesn't seem like a big deal. Like I said, AARP is shouting from the mountaintops that this is a bad idea, but I don't know that a lot of people are listening right now. So this could go through. Here's what it means for us and for our clients. It means that inflation, their adjustment for inflation on things like their Social Security checks, it's not going to go up very much. Now at first, there's not a huge difference between the CPIW and the chains CPI, and so it's not going to make that big a difference in people's lives. At first, it may seem like your Social Security check, it might only cost you $20 or $30 a month. And that's all right, and that's not a big deal to most people. I mean, most people can find ways around, their check being $15, $20, $25 less than it was. But over the course of several years, that's going to start to be more like $200 or $300. And that's a big deal. And so that's what it means to them. But here's what it can mean for you and things that you can do. I would suggest taking the long view and telling people that we just have to be more in control of our income. We can't help that Social Security checks aren't going to go up as fast as they used to, and so that we may end up behind the 8 ball when it comes to inflation. But can I recommend something? The SAIL plan. Now I know a lot of you are familiar with the SAIL plan and a lot of you use it. If you're newer, you may not have seen this yet. This is a way of laddering assets for both growth and safety so that someone's income is reliable and predictable. And if you've ever used a SAIL plan in a presentation in the past or worked with me on that, you know that income being reliable and predictable is a big deal. We make a huge deal. It's a huge point of emphasis with us. That your paycheck was reliable. You knew you were going to get it every 2 weeks. It was predictable. When you opened up the envelope, you knew what was going to be on there. It wasn't a surprise. You knew about how much you were going to get paid every 2 weeks, and that's what made it great. That's why we love paychecks, because we can plan for them. We can budget around them for the very reason that they're reliable and predictable. So when we stop working, we want our income in retirement to be reliable and predictable as well. That's why we love Social Security. We're going to get it every month. We know when it comes. We know when to look for it in the mailbox, and we know how much it's going to be. So it's reliable and predictable. What we want to do is make the rest of our income reliable and predictable in the same way. And the SAIL enables us to do that. So just as an example, if you're looking at this, this is somebody who started with a principal amount, if you look right in the middle there, of $500,000. What they did is they laddered that $500,000, and so in the first bucket we have $58,000 and change. In the second bucket we have $47,000 and change. In the third bucket we have $143,000 and change, and in the last bucket we have $250,000. That's how we get to that $500,000 in original principal. What we're doing is laddering the money so that we're using that $58,000 and change in the first bucket for income. That's what gives us this $1,000 a month in years 1 through 5. Now at the end of the 5th year, we've exhausted that 58,000. It's gone. It's down to 0. But we've gotten income for how many years? 5. And during that 5 years, we allowed buckets 2, 3, and 4 to do what? Grow. And so bucket 2, which started with 47,909, grew to this 55,652, and that's what we're going to use for our $1,000 a month in income in years 6 through 10. Now at the end of the 10th year, that bucket though will have been gone. It'll be spent down to 0. And sometimes people will say, okay, but you're spending my money. It's gone. There's none left. But you've been getting income for how many years? 10. And that 10 years has allowed buckets 3 and 4 to do what? Grow. And bucket 3, which started with 143,000 and change, has grown to 236,000 and change. And bucket 4, which started with 250, has grown to 502. So you've gotten income for 10 years, and at the end of the 10 years, you end up with 738,000, almost 739. Is that more or less than the 500 you started with? More. So if there was inflation, if we needed to give ourselves a raise, could we do it? Is there room to do that? And they always say, yeah, there's room. And now this only takes us to age 76, but if we have more money than we started with, what can we do from 76 to 86? Do it all over again. And so this is a way of getting income that's reliable and predictable, like a paycheck, and can help us to stay up with or even ahead of inflation. So think about that, because as we go forward and we can't rely on Social Security as much because they've changed the rules, and so you can't quite get the big check that maybe you could have in the past. And now they're talking about changing the rules again so that you're not going to quite get that inflation adjustment, which I think it's always been low, but now it's going to be lower. Especially for people on fixed incomes, people that are older who a lot of their cost is healthcare. It's not even close to keeping up with healthcare. It was never close to keeping up with things like healthcare. But now it's going to be a lot worse. And so we just have to be more in control of our income. We can't just rely on taking money out of a big bucket of stocks and bonds each and every month and hope that it doesn't run out. And we talk about that in the presentation. But this is an opportunity for us, especially if you're going to be doing annual reviews anyway. It gets slow around Thanksgiving through the holidays because people are busy with Thanksgiving and family and Christmas and New Year's. So really, you kind of have to shut down your marketing from about Thanksgiving through about the second week in January when you can ramp it up again. But during that time, there's a couple of things you could be doing. One, getting better at the 21, something that you're going to have in order to justify your fees more and more each year. Two, you could be doing annual reviews. And the fact that they're talking about changing the inflation adjustment, the CPI in the tax bill, gives you a perfect opportunity to have people back in. And if you haven't shown them the sale, it's an opportunity for you to have them back in and show them the sale plan and talk to them about really taking charge of their income, because we can't rely on the government giving us our income like we used to be able to rely on it. All right, so that's all I've got. Again, Mike's out of the office today, but everybody else is here. Everybody at ECA is here. Everybody else at 5Q is here. So if you call in, we're all here, and Mike will be back tomorrow. So thanks, guys, and we will talk to you again on Monday.